Myself, Ketan M. Patel from Mahatma Gandhi Institute of Technical Education and Research Center, Navsari, Electrical Engineering Department. Today we discuss about the subject name is Economics for Engineers, 4th semester, 2nd year. Chapter number 3, Cash Flow and Rate of Return Analysis. Okay. In chapter number 3, first syllabus content is incremental analysis, based alternative choosing, and analysis method, future worth analysis. Third one is benefit cost ratio analysis. Fourth is sensitivity and breakdown analysis. Fifth is economic analysis in the public sector. And sixth is quantifying and valuing benefits and its drawbacks. Okay. Now, first topic is incremental analysis. Now, what is incremental analysis? Managerial decisions are choices made based on financial and non-financial informations. Typically, financial information serves as the first hurdle in identifying a possible course of action as an alternative. If the financial hurdle is met, then management must consider the impact of the alternative on the environment, the company's employees, its image, the community, its partners or alliances, and so on before making a final decision. In this method, in this incremental analysis method of comparisons, the cash flow of each alternatives will be reduced to time zero by assuming an interest rate. Then, depending on the type of decision, the best alternative will be selected by comparing the present worth amounts of the alternatives. The sign of various amounts of different points in time in cash flow diagram is to be decided based on the type of decision problem. In a cost dominated cash flow diagram, the cost or outflow will be assigned with the positive sign and the profit, revenue, slavage value will be assigned with the negative sign. In a revenue profit dominated cash flow diagram, the profit, revenue, slavage value will be assigned with positive sign. The cost will be assigned with negative sign. In case the decision is to be select the alternative with the minimum cost, then the alternative with the least present worth method will be selected. On the other hand, if the decision is to select the alternative with the maximum profit, then the alternative with the maximum present worth will be selected. Now, incremental costing is frequently used for the different types of analysis. Several concepts are incorporated into incremental analysis and need to be defined before discussing some specific applications of incremental analysis. Here are some examples of incremental analysis. First is accepting an additional business. Based for comparison of alternatives, in most of the practical decision environments, executives will be forced to select the best alternative from a set of competing alternatives. Let us assume that an organization has a huge sum of money for potential investment, and there are three different projects whose initial outlay and annual revenue during their lives are known. The executive has to be selected the best alternative among these three competing projects. There are several based for comparing the worth lines of the project. Second is making a buying parts or products. Third one is selling products or processing them further. Fourth one is eliminating a segment. Fifth is allocating source resources. Now, first, incremental analysis is very important topic in economics for engineers. Incremental analysis is also the managerial decisions are choices made based on financial and non-financial informations. Typically, financial information serves as the first hurdle in identifying a possible course of action as an alternative. Now, the incremental analysis, also known as differential or marginal analysis, is a tool in accounting that business use to make short-term decisions. It identifies potential charges and revenue and cost that arise from the existing alternatives and choose that will result in the highest net income or the lowest price. Now, the incremental analysis using this regards any past or sunk cost, and it is useful when working on a business strategy such as to outsource a function or self-produce it. Incremental analysis involve the examinations of alternative choices based on the cost difference between them. This analysis is slowly concerned with the cost that will change if one alternative is selected over another. Any costs that do not change if either alternative is selected are ignored for the purpose of deciding which alternatives to purpose. For example, costs that have already been incurred or known as sunk cost are ignored. In previous slides, we different definitions are understood. If any type of cost will be incurred for both alternatives, then it also can be ignored. Incremental costing is frequently used for the following type of analysis. First is whether to retain production in house or outsource it, whether to maintain personnel in house or outsource their services, whether to accept a one time order from a customer, whether to rebuild an existing asset or replace it with a new one, whether to sell a product in its current conditions or keep processing it and sell it later. How to allocate scarce resources among a number of possible uses, such as the choices for allocating limited fund among several purpose capital project. Now, in incremental cost, some example like a company receives an order from a customer for 1000 unit of a given weight for 12 each. The company controller looks up the standard cost for a green widget and finds that it cost the company 14. Of these 14, 11 is variable cost and 3 is fixed cost. Since the fixed cost is being incurred irrespective of the proposed sale, it is classified as a sunk cost and ignored. This means that the incremental cost of the widget is 11. The company should accept the order since it will earn 1 per unit sold or 1000 in total. So, incremental analysis, sometimes called marginal or differential analysis, is used to analyze the financial information needed for decision making. It identifies the relevant revenue and or cost of each alternative and the expected impact of the alternative on future income. To illustrate the concept, think about the decision to lease or buy a car. Leasing involves the regular payment and the return of the vehicle at the end of the lease unless a one-time payment is made. This arrangement means the car does not legally belong to the person leasing it. To buy a car, require payment of the purchase price. The payment may be made in cash or by signing a note payable for the amount owed. If you were to prepare financial statements under each alternative, they would look very different. An operating lease for a car with payment of 300 per month would result in the annual cost of the lease 3600 being reported as an expense on an income statement. The purchase of car result in an asset and a liability if a note was signed being recorded on the company's balance sheet. In incremental analysis, the several concepts are incorporated into incremental analysis and need to be defined before discussing some specific applications of incremental analysis. First is relevant cost. Those revenue and cost that differ among alternatives as opposed to revenue and cost that stay the same, which are ignored when analyzing alternatives. Sunk cost. Second one is sunk cost. A cost that has already been incurred and therefore has no impact on future decisions because the cost will not change or go away in the future. The book value of previously purchased and currently owned assets will not change whether or not a new asset is purchased to replace it. Second one, opportunity cost. A potential benefit that is lost when a company chooses another alternative. And incremental analysis, sometimes called marginally or differential analysis, is used to analyze the financial information needed for decision making. It identifies the relevant revenue and or cost each alternative and the expected impact of the alternative on future income. Here are some examples like accepting additional business, so and so on. A little more on what is incremental analysis. An incremental analysis model consists of relevant costs that are divided into variable cost and fixed cost. The incremental analysis puts into consideration opportunity cost that refers to missed opportunity when you choose one alternative having the order to ensure that a firm pursue a favorable options. In other words, it identifies the revenue and cost that are relevant to the decision making process. The incremental analysis consists only on value that are relevant and remove the need of come up with a comparative data for those costs that are irrelevant. The model works on speeding up the process of decision making. The analysis primary concern is the cost that are likely to change in the future if you choose one alternative over another. So the unchanging cost resulting from selecting an alternative is ignored to decide which option to pursue. A good example is sunk cost, which are typically ignored because they have already been suffered. Also, where there is a possibility that the two alternatives will incur may other type of cost, such can be ignored. Now, there are many business situations in which you can use incremental analysis occurring. They include the decisions on whether to accept or reject a particular order. In most cases, special order are usually lower compared to their usually selling price. The incremental analysis will therefore help to allocate scarce resources to several products like so that they can be used to maximize profits. Incremental analysis can also be used when making decisions on where to buy goods or produce, remove a project, or rebuild an asset. The analysis model also gives you an insight into whether to continue creating a particular product or sell it at a given point in the manufacturing process. Another situations where firms can make use of incremental analysis is when deciding whether to make or buy products, accept additional business, sell or process further, do away with the product or services, and how to allocate resources. Now, second one is based alternative choosing and analysis method. Uh, in the real world, the majority of engineering economic analysis problems are alternative comparisons. In these problems, two or more mutually exclusive investments competitive for limited funds. A variety of methods exist for selecting the superior alternative from a group of proposals. Each method has its own merits and applications. Here is first is future worth analysis method. In the future worth analysis method of comparisons of alternatives, the future worth of various alternatives will be computed. Then the alternative with the maximum future worth of a net revenue or with the minimum future worth of net cost will be selected as the best alternative for implementations. In future worth analysis method, there are some different types of analysis. The first is revenue dominated cash flow diagram. Okay. In revenue dominated cash flow diagram, a generalized revenue dominated cash flow diagram to demonstrate the future worth method of comparison is presented. Here figure is revenue dominated cash flow diagram. This is a one line is a 0 to 1 2 3 up to y and up to n. Okay, and this is a number of r1 r2 r3 up to rj. Okay, and up to rn. Okay. And this is the capital P and this is the capital S. The its P represent the initial investment and RJ means the net revenue at the end of the jth year, and capital S is the slavage value of the end of the nth year. The formula for the future worth of the above cash flow diagram for a given interest rate I is equations is FW is equal to minus P in bracket 1 plus I is into N plus R1 1 plus I N minus 1 plus R2 in bracket 1 plus I N minus 2 plus up to plus Rj in bracket 1 plus I N minus j and plus Rn plus capital S. In this formula, the expenditure is assigned with the negative sign and the revenue are assigned with positive sign. These are the methods of revenue dominated cash flow diagram. Now, second one is cost dominated cash flow diagram. A generalized cost dominated cash flow diagram to demonstrate the future worth method of comparison is given in this figure. This also is one line diagram. This is a 0, 1, 2 up to j to n, and this one is C1, C2, Cj and Cn, and this is the capital P and capital S. In cost dominated cash flow diagram, the capital P is represented an initial investment. Cj is the net cost of operation and maintenance at the end of the jth year, and capital S is a slavage value at the end of the nth year. The formula for the future worth of the above cash flow diagram for a given interest rate I is a FWI equal to capital P in bracket 1 plus I into N plus C1 in bracket 1 plus I into N minus 1 plus C2 in bracket 1 plus I into N minus 2 plus up to plus Cj in bracket 1 plus I into N minus j plus in bracket Cn minus S. So these are the different methods of cost dominated cash flow diagram of future worth analysis. Okay. Now, next is benefit cost ratio analysis. The benefit cost ratio analysis method is often used in municipal project evaluations where benefits and cost occur the different segments of the community. With the method, the present worth of all benefits like irrespective of the beneficiaries is divided by the present worth of all the cost. This project is considered acceptable if the ratio equal to exceeds 1. They will be true wherever be 2 to 0. When the beneficial cost ratio method is used, dis- disbursements by the initiators or sponsors are cost. Disbursements by the users of the project are known as benefits. It is often difficult to determine whether as a class flow is a cost or a benefit. Regardless of where the cash flow is placed, an acceptable project will always have a beneficial benefit cost ratio greater than or equal to 1, although the actual numerical result will depend on the placement. For this reason, the beneficial cost ratio alone should not be used to rank competing projects. Now, regardless of where the cash flow is placed, an acceptable project will always have a beneficial cost ratio greater than or equal to 1 to 0, although the actual numerical result will be depend on the placement. In ranking is to be done by the beneficial cost ratio method in incremental analysis is required, as it is for the rate of return method. In incremental courses is accomplished by calculating the ratio of difference in benefits to differences in cost for each possible pair of alternative. If the ratio exceeds 1, alternative 2 is superior to alternative 1. Otherwise, alternative is 1 is superior. Now, sensitivity and breakdown analysis. A breakdown analysis is a method of determining when the value of one alternative becomes equal to a value of another. It is commonly used to determine when exactly equal its revenue cost. It is a manufactured quantity is less than the break-even quantity. A loss is incurred. If the manufactured quantity is the greater than the break-even quantity, a profit is made. An alternative from the break-even problem is to find the number of units per period for which two alternatives have the same total cost. Fixed costs are spread over a period longer than 1 year using the USA concept. One of the alternative will have the lower cost if production is less than the break-even point. The other will have a lower cost if production is greater than the break-even point. The payback period is defined as the length of time and usually in year for the cumulative net annual profit to equal to initial investment. It is tempting to introduce equivalence into payback period calculations, but the convention is not to C equal to PBP, payback period, equal to net annual profit is equal to 0. So this is the equations of conventions sensitivity of the breakdown analysis. Now, economic analysis in the public sector. Public sector economics examines the impacts of government revenue, expenditure and investment decisions. Area of emphasis include tax policy, education, transportation, poverty and welfare, delivery of public services and economic development. Public sector economics is an area of study that is directly relevant to our everyday lives. It affects the taxes we pay, the buses and train on which we travel, the worker who empty our binds the gases and electricity delivered to our homes and even the water coming out of our taps. Public sector economy is a concern with justifying the existence of governments and explaining how they affect economic activity. It explains how the invisible hand of the market is tempered by the visible hand of the government in the mixed economy of both private and public sectors adopted by the vast majority of nations. Traditionally, public sector economy has been concerned with the study of how governments can deal with the failure of markets to achieve efficient outcomes. Possible remedies which are considered include using public expenditure and taxation, taking some firms into the state ownership, and introducing regulations. These are all the area of microeconomic theory, policy and practice. But the very nature of the public sphere has recently changed. In particular, we need to take account of political economy. How alternative economy theory are used to provide intellectual justification for ideological, moral and ethical values. These have recently been made manifest in rolling back the frontiers of the state through privatization, contracting out to the private sector the provisions of public sectors. The use of private finance initiative and public-private partnerships for school educations, hospitals, and other public services, and reforms of social security benefits. We are used to thinking about the incentives the firms and individuals face in considering public sector or public choices. We consider the incentives that governments faces. An example of this is this use emissions permits rather than a carbon tax uh, in the European Union. The explanations for this cannot be economic. A carbon tax is a demonstrably preferable, but polluting industries resist the laying of a carbon tax, and so grandfathering, like a giving out permits for free, is a way to limit the emissions of carbon without coming up against significant political oppositions. In public sectors, economics is certainly not confined within the covers of a dry and dusty textbook. It is not heavily theoretical more nor a abstract area of intellectual inquiry. It is out there in a real world, influencing the small details that make up of our everyday lives. Uh, these are some examples of public sector investment project. Our first is public transportation systems. Second one is environmental regulations. Third one is flood control programs. Now, qualifying and valuing benefits and drawbacks. A cost benefit analysis should be seen not as a mechanism for deciding mechanically on the allocations of funds and resources among programs, but as a structure for weighting advantages and disadvantages. That is the or organization knowledge. Considering all the forms of benefits and costs that we were able to derive and momentary terms. The experimental program provided both additional benefits and additional cost are compared with the conventional treatment. However, the added benefits, some 1200 per patient per year, are nearly 400 more per patients per year than the added costs. A number of the forms of benefits and costs that we have measured in quantitative but non-monetary terms. So additional advantages of the community-based experimental program. The generalizability is of a single experiment is a limited, but the methodologies developed may be useful if their proper role is appreciable. Okay, so these are the all the qualifying, quantifying, and valuing benefits and its topics. Okay, thank you.